What are carrying charges in commodity spreads? Imagine you're holding a bag of coffee beans or a barrel of oil, waiting to sell it later. Every day you keep it, there are costs involved. These costs are what we call carrying charges. They are the expenses linked to holding a physical commodity or a futures contract over time. When traders look at futures prices for different months, these costs show up as the price difference between contracts. Carrying charges include several parts. First, storage costs are what you pay to keep the commodity safe in a warehouse, silo, or tank. For example, storing a barrel of oil might cost around $50 a month, depending on the facility and location. Then, there are insurance costs to protect against theft, damage, or spoilage. This could add another $5 to $10 per month. Financing costs are also part of carrying charges. If you borrow money to buy or store the commodity, you pay interest on that loan. For instance, if the interest rate is 5% annually, that adds to your overall costs. Lastly, there are other incidental expenses like handling, conditioning, or transportation, fees that might be necessary during storage. In futures markets, these costs become visible through the difference in prices between contracts that settle at different times. When the price of a later delivery contract is higher than an earlier one, it is called a positive carrying charge or a market in Contango. For example, if a December corn futures contract is priced at $4.17 per bushel, and a March contract is for $1.25, the 8-cent difference reflects the costs of storing and financing the corn from December to March. This premium covers the expenses involved in holding the commodity during that period. On the other hand, if the near-term futures price is higher than the later one, it results in negative carrying charges or backwardation. This situation often occurs when there is high demand or scarcity in the local market, making storage less attractive. For example, if immediate delivery prices are higher because of a sudden shortage, traders might prefer to sell now rather than store the commodity. Understanding carrying charges is vital for traders working with commodity spreads. When they buy one futures contract and sell another, the difference in prices often reflects these costs. If the market expects high carrying charges, the spread might widen, indicating more costs to hold the position. Conversely, low or negative charges can suggest a different supply and demand outlook. By analyzing these charges, investors can better judge whether to hold onto a futures position or to sell quickly. They also get clues about market conditions, like whether storage is becoming more expensive or if demand is pushing prices higher for immediate delivery. In essence, carrying charges are the economic toll of delaying a sale or consumption of a commodity. They shape the pricing of futures spreads and help traders make smarter decisions about when to buy or sell. Recognizing these costs allows investors to understand the true picture behind futures prices and the underlying supply and demand forces at play.